Good afternoon. Welcome. I'm David Wessel, Director of the Hutchins Center on Fiscal and Monetary Policy. Thank you all for coming in person and all the people watching online. We're very pleased to be hosting today's event with Fed Governor Lisa Cook. On the walls of the Federal Reserve Eccles Building, which is now undergoing a massive reconstruction, there's a quote from Carter Glass, the Virginia congressman who's probably better known for the glass in Glass-Steagall. And he says on there that one of the goals of the Federal Reserve Act of 1913, which he helped craft, was to, quote, correct and cure periodical financial debauches. So I suppose the Fed has been called upon to do just that from time to time, including responding to the global financial crisis. And given the pain and the cost of that crisis in 2007 and 2008, today, we as a society ask the Fed to do more than protect the economy from the fallout of financial crises. We ask the Fed, among others, to reduce the risks of these financial debauches, to strive for financial stability while also delivering price stability and maximum employment. Nobody said this was going to be easy. To that end, when Ben Bernanke was chair of the Federal Reserve, he created a division of financial stability at the Federal Reserve Board, which sits alongside the divisions of monetary affairs, research and statistics, and international finance. And twice a year now, the Federal Reserve publishes a financial stability report, the most recent of which was issued just a couple weeks ago. So overseeing the financial stability division is a committee of Federal Reserve Board governors, which is chaired by Governor Lisa Cook, who's with us today. A little about Governor Cook. She received a BA in philosophy from Spelman College, where I understand she organized a protest every year. And the subjects were divestment from South Africa, repealing the curfews, and more vegetarian options in the cafeteria. So she is someone with a wide range of interests, even as an undergrad. As a Marshall Scholar, she received a second BA in philosophy, politics, and economics from Oxford, and then earned her PhD in economics at the University of California, Berkeley. Before joining the Fed Board in May 2022, she spent nearly 19 years on the faculty of Michigan State, where she was a professor of economics and international relations. And you can read on the Fed website all the other things she's done, all her other accomplishments. But I want to mention one where I actually got to know Governor Cook was when she was director of the American Economics Association summer training program from 2018 to 2021. Following Governor Cook's remarks, she will join me on stage with my Hutchins Center colleague, Don Kohn, who's the John, you got to help me. How do we pronounce his last name?
Roosa.
Robert V. Roosa Chair in International Economics. Don was a member of the Federal Reserve Board from 2002 to 2010, the last several years of which he was vice chair. He spent 10 years as an external member of the Bank of England's Financial Policy Committee, which oversees financial stability issues in the UK. And Don and I and Governor Cook will be joined by Carolyn Wilkins. She happens to be a current member of the Bank of England's Financial Policy Committee. She's a veteran of the Bank of Canada, where she was senior deputy governor from 2014 to 2020, and she's now at Princeton's Griswold Center for Economic Policy Studies. And after we have a conversation, I'll welcome questions from the audience. And for that, now let me turn the podium over to Governor Cook.
Thank you, David, and thank you, Hutchins Center and the Brookings Institution, for hosting me today. I am especially grateful to return to the place where, in my first job as an aspiring economist, I was a research assistant for Alice Rivlin over 3 decades ago. Today, I would like to talk about the board's work in pursuit of financial stability, which is critical to the well-being of households, firms, and the broader economy. Following the financial crisis of 2007 to 9, a broad set of reforms was put in place to bolster financial stability. To ensure an ongoing focus on that area, the board established its Committee on Financial Stability as a venue for governors to discuss related developments and policy issues. I recently became chair of this committee and will share with you my current views on financial stability and touch on a couple of emerging issues. Enhancing the public's understanding of our work on financial stability is important for transparency and accountability of our efforts. That is why we communicate our financial stability work prominently in our Financial Stability Report, which was recently published last month and provides more detail on some of the developments I will review today. As the U.S. and financial system and global financial system continues to grow and evolve in complexity, the Fed's work on financial stability only becomes more important. A stable and resilient financial system is essential for the Federal Reserve to achieve its dual mandate of maximum employment and price stability. Our financial stability work also informs our approach and priorities to the supervision and regulation of banking organizations, our coordination with domestic regulatory bodies, and our engagement with international bodies such as the Financial Stability Board. When people think about financial stability, they most often recall periods affected by adverse shocks, that is, severe, unexpected events that cause widespread disruptions to the financial markets and, in turn, the broader economy. The challenge is that such events are hard to predict. Therefore, the Fed's financial stability framework focuses on understanding what makes the financial system vulnerable to a wide range of potential shocks and how those vulnerabilities might amplify the effects of those shocks, not on predicting specific adverse events. Based on extensive research and experience, we routinely monitor 4 broad sets of vulnerabilities to the financial system that could amplify shocks: household and business leverage, the use of leverage by financial institutions, the degree of maturity and liquidity transformation in the financial system, or in plain English, funding risk, and asset valuations and risk appetite. To lay out how I am currently thinking about each of these vulnerabilities, I will start with household and firm leverage. A simple measure of whether households or firms are borrowing too much is to compare their debt to the level of GDP, as shown in Figure 1. Based on this measure, household borrowing is lower than it has been in many years. Our analysis then dives deeper, including detailed assessments of mortgage borrowing and consumer credit, and this deeper assessment supports the view of a resilient household sector. Nonetheless, we are also attuned to possible changes in this assessment. For example, I am watching closely the rising delinquency rates associated with auto loans and credit card debt, both of which partially affect a normalization from recent lows. This is because they imply increasing household borrower stress, especially among some lower and moderate income households. From the figure, you can also see that, looking through the unusual pandemic period, business debt relative to GDP remains above historical norms. Despite this, most firms still have ample earnings to cover their scheduled interest and principal payments. This solid position reflects resilient earnings and the fact that firms with access to bond markets locked in long-term funding during the low interest rate environment of 2020 and 2021. As a result, most firms also appear, in broad terms, resilient to potential adverse shocks. Let me now turn to the leverage and funding risk in the financial sector. In assessing these vulnerabilities, we tend to place a lot of weight on the capital adequacy and liquidity of the largest and most interconnected financial firms. Currently, these firms appear well-positioned to absorb a shock. For instance, Figure 2 shows the ratio of Common Equity Tier 1 capital to risk-weighted assets, a standard regulatory capital measure for 3 groups of banks. This ratio has been increasing for all types of banks lately, and for the largest banks, stands at a multi-decade high. The largest banks also have strong funding profiles, owing in part to the strength of the regulatory regime for these banks. Despite the overall resilience of the banking sector, some regional banks experienced large deposit outflows amid the failures of 3 banks last spring. Conditions have improved considerably since then. Bank profitability remains solid, and deposit flows have stabilized. In addition, as is shown in Figure 3, most institutions have lowered their reliance on uninsured deposits since the beginning of 2023. We remain attuned to vulnerabilities in this sector. Supervisors are working closely with the set of banks that have experienced outsized fair value losses from higher interest rates and with banks that have a high concentration of commercial real estate loans. We have varying levels of visibility into the leverage and funding vulnerabilities of other financial intermediaries. While there are some areas of apparent vulnerability, there's also evidence of resilience. Hedge fund leverage is hard to measure, but available data suggests that these funds' leverage is near the high end of its range. Large insurers are well capitalized, but they have been increasing their use of liabilities subject to rollover risk at the same time as they have raised the portion of their assets invested in riskier corporate debt instruments. Money funds have inherent funding vulnerabilities that regulators have been taking steps to address. Reforms adopted by the SEC and coming into force this year will improve funds' liquidity positions and address the structural first-mover advantage among money fund investors that contributed to some of the runs we have seen in the sector over the years. Let me turn now to asset valuations. I think it is helpful to consider this potential vulnerability in the context of how a sharp change in valuations could interact with the vulnerabilities I have already discussed. I will start with the classic concern for all of us who lived through the Great Recession: a large decline in asset prices against the backdrop of a weak economy. For example, house prices are high relative to historical benchmarks, likely owing partly to a limited supply of homes for sale. What might the implications be if house prices were to weaken at some future date? The house price growth we have seen over the past few years has not been accompanied by increased lending or weaker credit standards, as was the case in the early 2000s. Moreover, the household sector is much more resilient than in 2006. One way to see this is to run the distribution of risk characteristics we see in the household sector through a constant set of income and house price shocks. The stronger underwriting standards that have prevailed since the post-crisis reforms went into effect and stronger household balance sheets mean that post-stress delinquency rates should be lower the next time we experience a housing shock. Finally, the financial system is in substantially stronger shape to resist any losses that do occur. The largest banks are subject to stress tests that require them to be able to continue to function through a severe recession, and important structural improvements have been implemented among non-bank entities. Now a turn to commercial real estate, or CRE, where the shocks created by the COVID-19 pandemic continue to reverberate. CRE is a broad asset class encompassing multifamily housing, hospitality, retail, warehouses, office buildings, and many other business properties. Accounting for this heterogeneity is important in assessing the risks associated with CRE. Properties have been differentially impacted by ways in which many people live, shop, and work. For example, occupancy rates of suburban medical offices are very different from those of downtown corporate headquarters. Looking at broader trends, values of office buildings have been most affected by lifestyle changes, and the values of multifamily properties have also dropped over the past year. These trends present challenges for property owners and lenders who will need to manage those risks and make appropriate adjustments as the outstanding loans come due. As the fourth quarter of last year, banks accounted for a bit more than half of the $6 trillion in outstanding debt backed by CRE. Figure 4 shows that much of that exposure is in smaller regional and community banks. On average, CRE loans make up only about 5% of total assets at large banks, but around 30% of assets at smaller banks. This high concentration has caused us to step up our supervisory work with community and regional banks that have significant CRE concentration and to augment our regulatory data for this sector. For instance, data available from SEC Form 10Q filings suggests that office exposure accounts for a small share of most regional bank CRE loans. All told, I view CRE risks currently as sizable but manageable, and I will be paying close attention to the sector in the short and medium run. Risks related to CRE are well known to investors and supervisors alike. Another big part of our job is to look for emerging vulnerabilities, and one that has garnered my attention is private debt. Private credit generally refers to direct loans made to businesses, mostly middle market firms, by non-bank entities such as private debt funds and business development companies. In the U.S., private credit funds' assets under management have grown rapidly in recent years. They were estimated to stand at $1.1 trillion in September 2023, comparable in size to both the high-yield bond market and institutional leveraged loan market. History teaches us that rapidly growing lending often involves weak underwriting or excessive risk appetite. The growth in private credit is likely attributable to a confluence of factors. After the financial crisis of 2007 to 2009, private equity investment and leveraged buyouts grew quickly, and demand for credit from middle market and private equity-sponsored firms grew along with them. Some borrowers appear to prefer private credit deals to bank lending because of easier deal execution and greater contractual flexibility, particularly during the ups and downs of the economic cycle. In addition, the growth of private credit coincided with a period in which stronger bank regulation and supervision were put in place, suggesting that those actions to make banks safer played a role. Overall, I think the growth of private credit likely has not materially adversely affected the financial system's resilience. Private credit funds appear well positioned to hold the riskiest parts of corporate lending. These intermediaries generally use little leverage and are organized as closed-end funds, which means that investors cannot withdraw the funding supporting the investment. Nonetheless, private credit funds have also growing interconnections with traditional financial intermediaries, including banks. Banks are increasingly originating their own private credit deals, such as through business development companies that are operated or minority owned by the banks themselves. As a result, I will be monitoring the contribution of private credit to the overall leverage of the business sector and the evolving interconnectedness between private credit and the rest of the financial system. I will conclude with a few thoughts on cyber risk. I should emphasize at the outset that the Federal Reserve's role in managing cyber vulnerabilities is focused primarily on ensuring the institutions we supervise effectively manage the cyber risks they face, including from key technology service providers to those institutions. It is also focused on safeguarding the resilience of the services provided by the Federal Reserve and the financial system more broadly in the event of a successful attack. We also work with our partners across the government, including the U.S. Department of Treasury, and with the private sector to understand and address cyber risks. Over the past few years, we have seen an accelerating tempo of cyber attacks from a mixed group of groups associated with criminal enterprises and hostile government. While the news sometimes seems dominated by ransomware attacks, we also continue to observe other types of attacks, such as those that seek to uncover information from governments and firms, or to carry out or plant the seeds for destructive attacks on information systems that could severely disrupt operations. In response to these risks, we are examining cyber incidents carefully to make sure we have a fuller understanding of how attacks can affect the financial system, including through banks, non-bank financial firms, digital service providers, and critical infrastructure. In this work, we focus heavily on the operational resilience of the institutions we supervise, the service providers used by the institutions, and the financial services provided by the Federal Reserve. We have also begun to incorporate analysis of timely data on firm-level cyber vulnerabilities and interconnections across firms, and with service providers to monitor cyber vulnerabilities at the system level. As we contemplate future incidents, my view is that financial resilience can play a crucial role in mitigating the adverse effects of cyber attacks. Cyber attacks erode the confidence that investors and institutions have in each other and in the financial sector. While strong capital and liquidity positions will not by themselves prevent an intrusion, they leave the affected institution in a better position to rejoin the system once the attack is resolved, and most importantly, promote confidence among its counterparties. Moreover, the effects of chaotic markets may impact other institutions that suddenly face losses whose magnitudes might be hard to judge. Well-capitalized, highly liquid, and well-managed institutions will be best positioned to manage such difficult circumstances. Let me conclude by summarizing how we approach the set of issues I have discussed, including system-wide monitoring, CRE and private credit development, and cyber risks in our financial stability work. We cannot know the next shock that will test the resilience of the financial system. That is why we focus on the resilience of the financial sector in our regulatory and supervisory work concerning banking organizations and in our engagement with other regulators. We also continuously monitor the financial system and regularly report on our assessments in the Financial Stability Report. Such public communication contributes to the transparency and accountability of our efforts. I hope it is also something that will stimulate a public discussion of vulnerabilities to financial stability, as my colleagues and I value the range of views on these issues held across researchers, financial market participants, and the broader public. For this reason, I look forward to our discussion. Again, thank you to the Hutchins Center and the Brookings Institution for hosting me today. Thank you.
Thank you very much, Governor Cook. One of the advantages of having a Federal Reserve governor who was a research assistant at Brookings is she knows to call it the Brookings Institution, which is about 50-50. Half the people, including people who work here, call us the Brookings Institute. So I'm glad you remember. And I'm particularly glad that you mentioned your work with Alice Rivlin, whose spirit pervades this institution as we all try to live up to the ideals she set for good policy analysis and good policy. Carolyn and Don, I thought I'd start with you, just ask you a little bit of reaction to Governor Cook's remarks on the Financial Stability Report. Basically, as I read it, the report says, well, the consumer's in pretty good shape. Business is in pretty good shape with a few things to worry about. We did a great job shoring up the big banks. We got some worries about the smaller banks given CRE. There's a lot of known unknowns out there, cyber, geopolitics, asset prices are elevated. If they fell quickly, that might cause some problems. I'm just wondering whether you see, and I should note that the whole point of a financial stability report is to say not the things that we feel good about, but what are the things that we should worry about. So I'm curious what you think we should worry about and where you think Governor Cook and the Fed have hit it right or where they overlook some things. Do you want to start, Carolyn?
Sure, thank you, and thanks for the invitation. No, I was quite amazed by how similar your assessment of the risk for the U.S. correspond with the Financial Policy Committee's assessments of the risk coming from the global financial system to the U.K. So, you're going to read things like CRE, private debt, the big troubles in different areas of non-bank financial intermediation. I think where we're particularly concerned is also with respect to the interaction between those risks and the vulnerabilities that we see on the sovereign debt side. It's hard for a central bank to say those things, but when you think about the LDI incident, which we can get into, the liability-driven...
No acronyms here. So what is the LDI incident? By the way, Carolyn is supposed to tell you she's speaking for herself and not the Bank of England.
Right. We can get it. Basically, what the point I'm trying to make is that you can get a trigger to these vulnerabilities that were so very well outlined that come from places that you might not necessarily expect. And in the UK, the trigger for a big stress in the gilt market came from a budget announcement that uncovered a lot of vulnerability in liability-driven investment that's undertaken by pension funds to manage their risks, basically related, that usually happen naturally because you've got your assets and your liabilities interact differently with interest rate and inflation risks, and so that needs to be managed. And so, you know, Governor Cook, when you spoke about thinking through not the individual vulnerabilities, but how they might interact and what kinds of scenarios or shocks could create some unraveling, like we saw in 2023, I think is the right route.
So you mentioned sovereign debt. So you're talking about U.S. Treasury here, or what?
Well, in this case, I was thinking about treasuries, but there's other countries that are indebted in the world. So, and it's important to understand the nature of this risk and the potential for a trigger. I mean, people go right away to outright default, but it doesn't have to be that. If you're in a treasury market that's got low liquidity, term spreads are really priced for perfection, you could just have a rapid change in risk sentiment over a couple of days that can create a spike in interest rates. In the UK, it was 130 basis points, which was on the 30-year gilt yield. It was twice as big as the biggest thing we've ever seen. You're not stress testing for that, but it nonetheless uncovers a vulnerability that's already there. And it usually happens through unmanaged leveraged, margin calls that create forced deleveraging, fire sales, and then that just amplifies the interest rate shock and requires some kind of response. Either the place where the trouble started, they've got their natural writing mechanisms, but it often lands in the lap of the Federal Reserve or another central bank.
Right. Don, are they worrying about the right things?
Yes, yes. I think it was a very comprehensive report, had all the things that I was worried about mentioned one way or another, and I thought your speech was a really nice exposition of the main points. And I want to add, I really like the fact that you're here, but also that you're highlighting this report. And I think we've struggled at the Bank of England, how do we get people to pay attention to our financial stability report? So I think giving a speech every 6 months or so with a financial stability report would be contributing to public understanding and interaction. So that I thought that this event is a good thing. I think I agree with Carolyn and I about the risk of rapid movements in asset prices. And as you pointed out, and as the financial stability report points out, a lot of assets seem to be priced in the upper tail of their historic distribution relative to cash flows and risk, very narrow risk spreads. So I think it's an issue, a financial stability issue, is if those things change, that's fine. I mean, asset prices are supposed to fluctuate. People make money, lose money, et cetera. But there are amplification mechanisms here. Right. So what do you see as the main amplification mechanisms with a asset price, a sharp movement in asset prices, and then what should the authorities, broadly speaking, not only the Fed, but maybe other authorities, be doing about those amplification mechanisms?
So certainly, asset prices for various classes are in the upper range of their historical distributions, as you were saying. So there can be amplifications for any of those assets. Equity markets, for corporate bond spreads, for residential real estate. So price declines, for example, a significant price decline can have significant effects on other, depending on the interconnections, on other asset prices, on other assets. So we worry in terms of vulnerabilities about those amplifications, no matter where they are and no matter what their asset class is. So we're monitoring them very closely, and this is a part of our supervisory program.
So I think you brought up in the report the limited capacity of the broker-dealers in the Treasury market. So are actions being taken to try and enhance the liquidity of the market? Carolyn obviously the sovereign debt market is at the heart of any financial system.
Right. So the Treasury market is extremely important to the Federal Reserve. It's a $26 trillion market, and it is liquid and resilient. Liquidity levels have been somewhat low recently, and this is something that we're monitoring closely, but the Treasury market has still functioned well. We work with several other agencies, the Treasury Department, the CFTC, the SEC, the New York Fed, to monitor developments in the Treasury market. But we have our eye on this.
Governor Cook, you mentioned, and the report does as well, that looking at the banks, that higher for longer could pose a problem for banks. We saw it played a role in the incidents last year with SVB and the other banks. And I'm wondering, just if we have this combination of rates are higher for longer, the small and regional banks have a lot of CRE loans, how big a risk is this beyond just to the individual banks, but to financial stability in general, and what do we do to minimize those risks?
CRE specifically.
CRE and the losses on their portforios from hold-to-maturity loans.
Right. CRE, as I was saying in my speech, is a problem for smaller and regional banks. Roughly 30% of their assets are in these loans. So in our supervisory efforts, we are encouraging banks to increase loan loss provisioning, to implement their risk management strategies. So again, our framework is focus on the vulnerabilities, make sure that the shock absorbers work, and this is one way in which we would do that. But we're always monitoring this closely.
Carolyn, the Fed report, and I know the FBC report as well, talks about something broadly defined as geopolitical risk, of which there seems to be an extra amount at the moment. And I'm wondering how you think about preparing a financial system for something as hard to predict as what's going on in the Middle East, the Red Sea, shipping, terrorism, what's going on in Ukraine, and if it spills over to the rest of Europe. I mean, is that a tail risk that we just can't expect the financial system to insure against, and that's why we have central banks? Or is there something you can do as a financial stability monitor to help make the system more resilient?
Well, I think that it's a bit of both. There's a role for self-insurance for different kinds of risks, including some shocks that come from the geopolitical part of the world. But then there's always a role for the central bank and governments. And the way that we're approaching it is with, I must say, with a lot of humility, because no one really knows how it's going to turn out. And so it has to be about different forms that risk can take and channels through which it can propagate. And so the most obvious one is, the short-term risks that come to positive risk to inflation that could mean that interest rates either have to rise or they have to be high for longer, which is something that Governor Cook and others have talked about as being a bit of an issue for financial stability. But it can come through other doors. It can come through the cyber door, and not through ransomware, but trying to shut things down. And of course, there's a role for central banks in the area that's in their purview to think about how do we make sure the system's ready for that. And that's not something you do in a week. It's something that you need to have started before, and many central banks have. And that just doesn't include necessarily the institutions that you oversee directly, but those that are third parties, like cloud, for example, that are really critical to the operations of particularly globally systemically important financial institutions. And so there's things you can do. The Bank of England has an operational resilience framework we just published. We have a critical third party framework that we've published that's looking at gaps and trying to fill them in terms of what are our expectations for institutions to do things themselves. I think the final thing, and this may not seem to be in line with the geopolitical side, but I think it is, because some of these shocks and the realignment of asset prices that can come suddenly uncover the vulnerabilities, think hard about the banking system, but we don't think as hard about the non-bank financial intermediation. And I think understanding how those would act on an individual hedge fund or an LDI fund or something is one thing. But understanding how that system interacts is a much bigger and harder thing. And that's actually where the problem lies. And so another thing you can do, and it's a start, so all humility, is a system-wide exercise where you try to get, we're doing this at the Bank of England where we've got over 50 non-bank financial institutions plus the regular banks, the regular players, and we're going through a scenario that's a 10-day high-stress asset price move to see how individual institutions would react and how those reactions could either amplify the situation, probably amplify the situation, and how individual companies need to change their plans. You asked about the central bank. At the end of the day, it also means that maybe for a big enough risk, we have to be there, and it's a question of are our facilities following the right principles and set up and pre-positioned in a way that we can act quickly in a targeted way that's proportional to what's going on.
So David, can I comment on Carolyn's thing? And both Carolyn and Governor Cook have mentioned the sudden, unexpected changes in rates. And I think perhaps the most important role the Federal Reserve or central bank can play as Carolyn was getting to at the end, a backup source of liquidity for solvent institutions that are under stress because they didn't anticipate this well enough. And that means active use of the discount window. We know the Federal Reserve has faced challenges. There's stigma to using the discount window. It's called the lender of last resort. So whenever anyone comes, there's a suspicion that it's the last resort. But we also know that the Federal Reserve has taken steps to destigmatize, to make it more useful as was intended by the founders of the institution in 1913. Can you explicate a little bit on the steps that the Fed has been taking to help with that?
Certainly. So the discount window functioned well during the pandemic and during the banking stress of last year. And it provided liquidity when firms and households needed this. And it made sure that monetary policy was still being implemented because it was lending to a broad range of counterparties. So it has been working well, but certainly efficiency can be improved. That's certainly true. One thing that we're doing is encouraging banks, our supervisors are encouraging banks to pre-position collateral, for example. And that is going well so far. In the last year, an additional $1 trillion has been pre-positioned in collateral. So that's progress. But obviously, it's not complete. We're not done. So we continue to push forward on improving the efficiency of the discount window.
Thank you. So, Governor Cook, you taught economics in the classroom for a couple of decades. And now you've found yourself at the Federal Reserve talking about financial stability. And I wonder, what have you learned that you didn't know when you were in the classroom? Other than the press is your friend. I know that's one of the things you learned.
Everything? No. You know, it's just amazing that there are lessons that I've been teaching that didn't include as much institutional detail. And these institutional details matter. How the discount window functions actually matters. And I think I just sort of waved my hands about that and a lot of other things, but this actually matters. The types of 13.3 facilities matters. The type of disruption matters, and therefore the response matters. So I think it has to do mainly with institutional detail. So I have a lot of slides from my classes that I need to update as soon as I think about getting back in the classroom.
Both Carolyn and to a lesser extent Don talked about financial institutions outside the banks, the non-bank financial institutions. You mentioned in your remarks concerns about private credit. You said, I think the party line is, it doesn't seem to be a problem, but it's growing awfully fast, and that's a red flag sometimes. You mentioned that life insurance companies are getting more creative, both on the liability and the asset side, taking more risk on one side and having liquidity risks on the other. Do you think that the Federal Reserve and the Financial Stability Oversight Council in general have enough data and information on the non-bank financial institutions?
Certainly, there is opacity there. We don't have as much information as we'd like, but we have some. And we do know, for example, that life insurers hold 15% of CRE loans. So given that, we can keep monitoring what we know, and with our counterparts, these other agencies, gather as much information as we can. But we keep our eye on not just the entities themselves, but the interconnections and the layers of leverage that might exist in this more opaque sector. So we're monitoring that closely.
And before I turn to the audience, I don't want to neglect the consumer and the household. You pointed out, and your chart showed very well, that in general, the American household seems to be in pretty good shape. That's for sure. But you mentioned a couple concerns about delinquency rates on auto loans, credit card debt. And I wonder, what are you thinking about that? What's your worry? Is it in the danger zone, or is it just heading in a direction that's worrisome? How are you thinking about that?
Yes, the delinquency rates among low credit scores, households with low credit scores, are rising. So for credit cards, for auto loans, and we're monitoring this, and we obviously wonder whether other types of credit that they may be using, let's say buy now, pay later, may underestimate, the official data may underestimate actually how much delinquency there actually is in the system. But we're monitoring this closely, and we certainly don't want to discount it, because you could say the same thing about subprime loans, that a certain sector had them, but they're an important part of the system.
So buy now, pay later, that doesn't show up, right, in the consumer credit numbers?
That's right, exactly. Not reported to credit agencies.
I want to turn to the audience, and here's the deal. I'm going to ask for 2 or 3 questions, and then we'll answer whichever ones we like. Don't give a speech, ask a question. Do you want to start with Pedro in the back?
Thank you, David. Thank you, Governor Cook. You mentioned the importance of...
yourself.
Sure, sorry. Pedro da Costa with M&I. Thank you. You mentioned the importance of institutional detail. Could you tell us a little bit more about the Committee for Financial Stability works within the board, who's on it, and how you guys might interact with the monetary policy setting side of the Fed system, especially as it relates to considerations about winding down the balance sheet? Thank you.
So you're a little hard to hear, Pedro, but I think what you're asking to talk a little more about what the Committee on Financial Stability, who's on it, and what it does. And there's a guy to your left there.
Hi, I'm Aaron Cadell from Global Counsel here in Washington, D.C. We're a policy advocacy firm for companies and banks. And my question for Governor Cook as well as the others is, we're about a year out from the incidents of last spring with the sale of First Republic to J.P. Morgan, the collapse of Silicon Valley. There was a lot of debate around all kinds of things, the moral hazard that may have led to in the actions by the Fed, should there be universal deposit insurance, and so forth. So my question to you is, what were the lessons learned from that set of incidents of last spring, now with a year of reflection since the incidents of spring of 2023, Silicon Valley and so forth? Thank you.
In the front here. You stand up. Thanks.
Thank you. Kemi Oshikoya from the Africa Bazaar magazine. My question relates to the sovereign debt that you mentioned and the global financial system. How concerned are you about the high debt distress in emerging and lower income countries and the impact that we have on the U.S. economic? I know the U.S. economic is doing great right now, but how concerned about the impact of what is going on in these countries? Thank you.
So, Lisa, why don't you start with the first one? What is the Financial Stability Committee? Who's on it beside you, and what do you do anyways?
I think I can say who's on it, because I think that's on the website.
Public, yeah.
I think so. Okay. So I never know. I'm still learning this stuff, David. So thank you. Thank you, David and Don. Thank you very much. So Adriana Kugler, my classmate from Berkeley, and Chris Waller. I'm sorry, not Chris Waller. Vice Chair for Supervision Bar. I just came from a meeting with Chris Waller, another committee that I'm on. We largely oversee the production of the Financial Stability Report. So we're the ones getting the updates and deciding what should be highlighted in the report, what we should convey, what is consistent with transparency and accountability. That's largely what we do.
There are quarterly reports from the Financial Stability people to the FOMC. Or you get involved in that as well?
That's right. That's right. They coincide, but the other one is more frequent. Yeah. That's right. Yeah.
So Don and Carolyn, I wonder if you could help with the question about what are 1 to 2 lessons you think we learned from the March 2023 episode that Governor Cook should keep in mind and her colleagues?
I think there are a couple from the 2023 episode. One is that uninsured deposits can run very, very quickly, particularly in this age of social media. Words spread very, very quickly. So whatever liquidity requirements are there need to be altered to take account of the changing environment. I think another one is the importance of knowing what the mark-to-market value is of the institutions, because it was the announcement that Silicon Valley Bank needed to raise capital because of their mark-to-market losses that triggered the run. And I think the third one is how much change needed to happen in the Federal Reserve supervision of these banks. And this was in the Barr report, and in other reports on the thing, that the supervisors moved too slowly. They were too deferential in terms of giving folks time. So the need to escalate concerns to a higher level more forcefully sooner in the supervisory aspect. And I suspect that's been implemented at the Federal Reserve.
What about you, Carolyn? What did you learn?
Well, just comparing different jurisdictions and the regulations there in the first place, clearly capitalizing against interest rate risk on the banking book under Pillar 2 is a good idea. Not only because it helps against that kind of risk. I don't think in this case they could ever have enough capital given the run, but it creates the incentives to think about how the asset side of your balance sheet is constructed. And so that would be the first lesson. The second is there's a the liquidity coverage ratio wasn't followed by SVB. But even if it had been, I think there's a question about how do you calibrate those and think about the flight risk on operational deposits? Because, and that sounds really technical, but it matters a lot. And so
Operational deposits, you mean like business transactions?
business uninsured deposits, and so
Someone's payroll account, for instance.
because those are probably stickier than other kinds of deposits that are uninsured, and so to me that's kind of a practical implication for how you apply regulations. I think that regulation really matters. One of the things that doesn't get talked about enough is just governance, and it's governance of financial institutions to begin with. Because I'm on the board of directors of an insurance company, P&C, not in life, in Canada, and I'm on the risk committee, and I just can't fathom how a board of governors a board of directors could think through, yes, we want to grow this fast, but we're not going to think of the risks that are accumulating with that such rapid growth and that structure of a balance sheet that we have. And so I think that the governance, it starts with governance of the financial institution to begin with, and that should be a priority, not only of the institution, but of regulation and supervisors. And then the last one is just about central bank liquidity facilities. There's been a lot of work afterwards by the Bank of England and others thinking about, well, how can we be ready with, say, pre-positioned collateral with facilities that think through all the risks, whether it's moral hazard, whether it's risk to monetary policy stance, whatever it is. Having those at the ready and tailored to different types of issues we could have, I think would have been helpful to stabilize the system, maybe with less potential risk to the taxpayer. Central banks can come up with things quickly, and thank goodness they can, but having thought through some of the principles and pre-positioning things in advance can also be helpful.
Governor Cook, you're welcome to comment on those, but I wanted to give you a chance to respond to the question about whether you worry about the spillovers of emerging market debt on. No, it's for Governor Cook.
Yeah.
Is that like on your radar?
It certainly, our mandate relates to the U.S. economy. So we take all conditions from the models we use and make monetary policy decisions for the American people. So we're monitoring those conditions abroad. But I just wanted to add one more thing to the lessons that came up during the review of SVB, of the failure of SVB, and that's concentration of depositors. And I think that that's something, clearly it said, we hadn't paid as much supervisory attention to, and I think it's certainly something we are paying more attention to going forward.
Yeah, we're always ready for the last war. Here, there's a question here, and then Eli, can you go over here to the people in the aisle there?
Hi, my name's Alex Graff. I'm a banking reporter at S&P Global. I wanted to ask, you laid out some of the areas that you're looking at for financial stability, but I wanted to ask what you see as maybe the biggest area area of risk for potential bank failures, additional bank failures down the line. Yeah.
Okay, thank you.
Hi, good afternoon. My name is Talia Bradshaw. My question is, are you guys all concerned about Reg II's effect on LMI's community access to banking and how that will affect programs such as Bank On?
Reg I?
Reg II, the debit card interchange fee cap.
Okay, thank you. Right behind her.
Hi, Cal Fitzgerald with the National. Thank you for taking my question. Another question about banking. Last week, Fed Chair Powell said that no decision was made on Basel III. So I just wanted to see if Governor Cook, you could give us an update on the conversations you've been having with your colleagues on this and what the status is today.
Lisa, there are three for you. Basel III, Reg II, and what's going to be the cause of the next bank failure? You get to pick.
Okay.
There's at least 2 out of 3 questions you should answer.
Okay. So on Basel III, I'll say what Jay said. certainly there are conversations that are happening, but he would be the first one to reveal that. But we received a lot of comments, and we're taking those comments seriously, and we look forward to the ongoing conversation. With respect to additional stress in the banking system, so in general, the banking system is sound and resilient, and there are high levels of capital, particularly in the largest banks. As I said earlier, CRE is more of a problem in smaller banks and smaller and community banks. But the framework that we have with respect to financial stability would address should address any additional problem like this. So we're monitoring how resilient these banks will be, and that's through our supervisory efforts, encouraging them to place collateral at the discount window to increase loan loss provisioning and so on. So we're thinking about it broadly, but the key is to check the shock absorbers on the car. Make sure that it can drive.
There's one over here. There was a guy who's now looking at his phone who had a question.
Thank you. My name is Vijay Lipuri from U.S. Customs, and my question is related to the buy now, pay later apps that have been growing very much more common. A lot of these apps owners are issuing securities, bonds in the financial markets. What happens when consumers start taking on too much of that debt and they default on it? How will you, what steps can the Federal Reserve take to shore up resiliency on the financial market side for these lenders?
Are you asking about, I'm sorry, are you asking about the lenders or the consumers?
The buy now, pay later, the institutions themselves.
The lenders.
The lenders, right, okay.
Maybe one more?
Hi, Michael Redmond from Medley Advisors, and I just had a question on the life insurance risks. Could you just detail the possible scenarios that you have in mind for how those could generate financial stability, in a way that's a little bit more concrete for us to understand?
And there's one more, and that would be the last one.
I'm Aaron Mulkway from Bloomberg News. Governor Cook, I wonder if you could say more about how the Fed potentially holding rates higher for longer could impact some of these vulnerabilities that you've identified, particularly on non-bank lending and consumer stress, borrowing stress.
Thanks. Okay. Are you focused at all on the lender side of the buy now, pay later side, Governor Cook? I don't know.
Okay, so I mentioned that just because there was an article about it today. I don't think I should have brought that up. I'm just saying that there are places where there are potential vulnerabilities, and we're paying attention to those. We're collecting more data. We're trying to get a line of sight into these data series that we typically don't have much insight into. So that's just one more of them. So I would treat buy now, pay later lenders just like any non-bank lenders, even though they may, they may have connections to banking institutions, but our vulnerabilities framework should operate similarly in terms of the vulnerabilities that might arise there and the amplification that might arise there.
So in the report, you say that life insurers are taking on liquidity and credit risk by allocating an increasing percentage of their assets to risky and less liquid instruments. You mentioned private credit as one of them, leveraged loans. And on the other hand, their liabilities are getting more unusual, like guaranteed returns and stuff.
That's right.
So is this something that you are spending a lot of time thinking about what this vulnerability could be? Or is this just sort of like on the long list of things we ought to watch?
A and B? Yeah. But to be more concrete, if I can think of a concrete example, again, 15% of CRE loans belong to life insurers. That's a place where there is potentially vulnerability. So we have to watch this really closely and make sure that they are doing the same kinds of things, taking the same kinds of measures that the banks we supervise are. So I think that's a concrete example. I think to me that's the most concrete example.
Right, but you also mentioned the question on private credit about interconnectedness.
Yes.
And a lot of the private equity funds that are doing private credit are buying insurance companies because that's where the money is.
That's
So-
right. That's right. That's right. That's right.
And
Lots of
finally,
interconnections.
Amara's question was, Amara, was it basically, how worried is she about banks not being ready for higher for longer, or what?
Yeah,
What is the concern about rates being higher for longer on the banks? What is it that would make you, what's the issue for the banks, and what do you do about it?
What we do about it is to make sure that we are achieving both sides of our dual mandate. So price stability is financial stability. So the best we can do with respect, and the best monetary policy can do, is to promote stable prices. So that's the fight we've been engaged in. Inflation was at its peak 7%, and now it's below 3%. So our focus is on meeting the dual mandate, and I think that that's largely where we're focused and what we're monitoring, and we'll keep at that fight.
And Don and Carolyn, is there anything you think we should hit that we should not leave the audience without mentioning?
I think it's been quite comprehensive.
We got all the risks? There's nothing else? No other risks that we didn't mention?
We didn't mention China.
China. Okay, China, noted. China is also, but, so that's really more of a problem for the UK than for the US. But what do you have in mind when you say that?
Well, I thought about it in terms of just their growth path, and in fact, the question that was asked about emerging market debt and the interdependency between China and some emerging markets that may have debt that's not denominated in their own currency. And they're relying on China for exports and their economic well-being. And if China isn't that source, or has a hiccup, then that could be the trigger that creates some stress in that area. And we know from history, we know in the 90s there were one emerging market, different reasons, but one emerging market thing after another that did spill over into global financial markets and affected different economies. For sure, less the U.S. than others, but I don't think we should underestimate that.
So when you think of the financial stability risks to the UK, is China up there on your list?
China is something that we mentioned in the financial policy report that we set out in March. Part of that was working through emerging markets. The other part is just direct exposures for some financial
you got a couple of banks. Yeah.
And I think just in general, the macro risk there. China has been there as a lowering prices. It's been there to be the counterbalance to bring global growth up at times when, because their economies aren't necessarily synchronized with the U.S., and just that structural, change that's coming from them, demographic change being the biggest driver, kind of changes the pattern, the macroeconomic cycle patterns that we need to better understand as we do scenario analysis about how things could play out, how bad can it get. And I think that's big enough to make a change.
Great, thank you. Thank you all for coming. Please join me in thanking Governor Cook.
Thank you.
And if you be popular with our maintenance people,